So, you have an idea for a startup. It's a decent idea. You have users, you see the traction building, and it's finally time to raise funding to take this idea from a few people in a garage to an actual company. What should you do? In this video, we will explore 5 of the most common methods of funding a startup and the pros and cons of each method. Angel investors. Angel investors are wealthy individuals who self-fund early-stage startups in exchange for equity. Angels typically invest in startups that have a high potential for growth, and angels are willing to take on significant risk. The advantages of angel investing include access to capital and expertise from experienced entrepreneurs, valuable guidance, and connections to industry experts. However, the disadvantages of angel investing include the potential loss of control and dilution of ownership that comes with equity financing. Angel investors also demand a high return on investment and may be difficult to find for startups outside of major tech hubs. Lastly, since angels are putting up their own money, they often involve themselves much more in a company than a venture firm would. This can either be good or bad. Venture capital. Venture capital firms invest in startups that have already established a product or service and have shown traction in the market. They provide funding in exchange for equity and typically invest in startups that have a high potential for growth. The advantages of venture capital include access to significant capital and expertise from experienced startup investors. In addition, venture capital firms may provide valuable connections to other investors, industry experts, and even potential customers. However, the disadvantages of venture capital include the potential loss of control and dilution of ownership that comes along with equity investing. Venture capital firms may also demand a high return on investment and may pressure startups to achieve rapid growth at the expense of profitability. Conventional business loans. Conventional business loans are loans provided by banks or other financial institutions to startups. They are typically secured by the startup's assets or future cash flows. The advantages of conventional business loans include the ability to maintain full ownership and control, as startups are not required to give up equity. Conventional business loans can be very attractive to startups which do not want to give up a large stake in their company. However, the disadvantages of conventional business loans include the potential for high interest rates, the need to pay back the loan with interest, and a higher barrier to entry than equity funding. Startups that are unable to make their loan payments may be forced to give up assets to repay the loan. Venture debt. Venture debt is a type of debt financing that provides startups with a loan instead of an equity investment. However, many venture debt deals include a provision that allows the lender to convert part of the debt financing into equity in the startup, if the lender so chooses. The loan is typically backed by the startup's assets or future cash flows and is a hybrid between venture funding and a conventional business loan. The advantages of venture debt are similar to that of a conventional loan, including the ability to maintain more ownership and control. In addition, venture debt can be less dilutive than equity financing even when redeemed for stock, which can be attractive to startups that do not want to give up too large of a stake in their company. However, the disadvantages of venture debt include the potential for high interest rates and the need to pay back the loan, in addition to the uncertainty as to whether the lender will or won't redeem some of their debt for equity in the company. Crowdfunding. Crowdfunding is a method of raising capital from a large number of people, typically through online platforms. Crowdfunding can take several forms, including reward-based, equity-based, or donation-based. The advantages of crowdfunding include the ability to raise capital without diluting ownership, as investors are typically rewarded with a product or service instead of equity. In addition, crowdfunding can help startups validate their business model and generate interest in their product or service, kind of like free marketing. However, the disadvantages of crowdfunding include the need to generate interest and excitement in the campaign, and in most cases, offers the lowest ceiling on how much money a startup can raise. Raising $500,000 from a venture capital firm or angel investor is no easy feat, but raising $500,000 through tons of $20 contributions is quite difficult. There are 5 of the most common ways to fund your startup. Each option has its pros and cons, and it's important to consider which option is the best fit for your startup's needs. Many of the greatest startup success stories of our age use a combination of some or all of these funding methods. The key is to find the funding that aligns with your business's goals and vision. Thanks for watching.